And welcome to the show remotely this weekend. Jerry is
All
up in
right, all right.
Massachusetts. I'm down in Virginia, and he's having more fun than me.
It is pretty nice up here in the undisclosed Boston area. Um, it's definitely nice up here. I'm looking forward to getting on the beach a little bit for Labor Day, so we shall see.
Just rub it in, man. Just rub it in. Let's
But
talk
before we
about
get to
TSP,
that,
bro.
before we get to that, we got a podcast to do. All right, TSP Weekly Podcast. I cannot believe it's September 1st, but here we go. So we're going to take a look at what happened this week, and then the two most important things in terms of whether or not we go into recession anytime soon is GDP and the rate of unemployment. And as we kind of talk through that, it's going to kind of lead into two Facebook posts that we got in the Facebook group over the past week or so. And then we'll take a look at the TSP Fund charts. So what happened this week? Monday, no really big economic news. Market was down a little bit, 0.32%. Tuesday, the Case-Shiller home price report comes out, right? So this is the national year-over-year number. So it's the national number. It's certainly much different in Massachusetts than it is in Florida, for example. But the national number, prices increased 6.5% year over year. And consumer confidence also ticked up a little bit from 103.3 or to 103.3 from 101.9 last month. So the market apparently liked that a little bit. I don't know if you could draw that from there, but the market was pretty much flat, up 0.16% for the day. But home prices still going up and consumer confidence actually ticking up, which is interesting. Then Wednesday, market's down 0.6, so pretty big down day for the S&P. But all eyes were on NVIDIA because NVIDIA earnings were coming out after the close on Wednesday. Earnings were better than expected. They beat expectations, but they didn't beat by enough. And so NVIDIA after hours was down 7%. I think it closed Thursday down like 5%, something like that. But by Thursday morning, the market was way off in after hours on Wednesday night. But by Thursday, the market shrugs off the NVIDIA earnings, and it looked to this really positive, like we said, revision to the second quarter GDP. So it was revised up to 3%. So if GDP is actually going up, then the traditional definition of a recession is 2 consecutive quarters of negative GDP growth. So if GDP is going up, it pushes back a recession scare, right? At the same time, it's pushing back a recession scare. It's also making it more difficult for the Fed to cut rates. So it's like this teeter-totter kind of thing. There was a really good rally early in the day on Thursday, and then it all reversed. And by the end of the day, the S&P closed basically flat for the day. And then Friday, we're recording this here about 11:15. Personal consumption expenditures report came out at 8:30. Analysts expected PCE to move slightly higher, which it did, which means inflation is still moving higher. And if we recall from last week, the Fed came out and said that inflation is they're confident that inflation is now on the path to its 2% goal, and they're expecting to do rate cuts in September. Well, if PCE comes in higher than expected, and it means inflation is not slowing down, it makes it more difficult for the Fed to cut rates. But analysts are still expecting a quarter point rate cut in September. So we'll have to see how that rolls out. There's not a whole lot more data that's going to happen between now and the end of September when the next Fed meeting is. Okay, so GDP. So the term gets thrown around a lot. This is the Investopedia definition of it. So GDP is the total monetary or market value of all finished goods and services produced within a country's borders over a specific time period. So it's the gross domestic product, right? It's what is produced within the United States. So it doesn't count things that are American companies produced outside the United States. It's only things that are produced in the United States, and the time period is usually a year, year over year, but they also look at quarter over quarter. So it's a broad measure of overall domestic production, functions as a comprehensive scorecard for a given country's economic health. GDP is typically calculated on an annual basis. It's sometimes calculated on a quarterly basis as well. In the US, the government releases an annualized GDP estimate for each fiscal quarter and also for the calendar year. So individual data sets included in this report are given in real terms, so the data is adjusted for prices and is therefore net of inflation. What that means is there's a nominal GDP and a real GDP. Nominal is what the percent, so inflation artificially causes GDP to be higher. And when the nominal GDP number is going to be higher than the real GDP number in times of high inflation, which we have now. So the real GDP number takes out the inflation component and it gives you what the real amount of production is. So you want to look at the real GDP number. So going back to 2020, this is the third quarter of 2020 is the recovery from COVID. So we had a huge increase in GDP, but back here, it would have been really negative, right? Because we closed down the economy. So this is the first quarter of real recovery after COVID, and then it starts to settle back down. In the beginning of 2022, you may have heard about a lot of people saying, hey, we had 2 negative quarters of GDP growth, but we technically the National Bureau of Economic Research that tells us whether or not we're in recession did not declare that we were in a recession back here because unemployment was still really low. So they look at a whole lot of things. It's not just 2 consecutive quarters of negative GDP growth. Otherwise, they would have said we were in a recession here. So now in 2024, this is the quarter that just got revised up to 3%. And we've had 2 consecutive quarters of increasing GDP growth. So from that definition, where we couldn't be in recession until sometime in 2025 at the earliest. Okay, so that's from that definition. That definition, if you push it forward, we could be in recession in 2025. That's the GDP piece, and this is what it kind of looks like. So the green areas are recessions going back to 1990, and you can see that the black line is GDP growth. So when you have 2 consecutive quarters of negative GDP growth, we're in recession. Okay, and the line is always going up and to the right because it's cumulative. So if you increase GDP by 2, 3, 4% a year, the line keeps moving higher, which is why it looks like growth just keeps on going, which it does. But these areas where it flattens out or turns down are the recessionary periods. And then, okay, so unemployment. Unemployment is the second piece, and we talked about the SOM rule over the past few weeks. This is a chart of the unemployment rate in black and the recession periods in green. Okay, so we're going back to like 1950. So every time unemployment starts to accelerate to the upside, every single time it accelerates to the upside, we are beginning a recession. There's nowhere on this chart where unemployment accelerates to the upside and we do not go into recession. It happens every single time. Where we are right now, we have just crossed that threshold of an acceleration to the upside. So is it possible that unemployment just stops going up, right, and starts rolling over? There's no precedent for that anywhere in this chart. In the realm of possibility, it's always possible. There's just no historical precedent for it. So if unemployment continues to accelerate, which we would expect based on the history going back to 1950, what happens to the stock funds, particularly the S&P 500 RC fund, if we are on the cusp of a recession, right? So this is what the S&P 500 looks like over all those time periods. So every time during all these recessionary periods, the S&P 500 goes down every single time. So if we're going into recession next year, we should expect the S&P 500 to go down. All the macroeconomic indicators are indicating that we are heading into a recession. Is a soft landing possible? Yes. There's no getting a soft landing. We are in it now. This is the soft landing. The question is, has the Fed kept rates too high for too long? And is the market going to start to roll over, and then the Fed cuts rates to try to put a floor under falling stock prices? All the indicators are that we go into a recession late this year, the beginning of next year. And we know that the S&P always goes down during recession. This 1975, it doesn't look like it on that chart. That was a 50% drawdown. The 2000 to 2003 was a 50% drawdown. The Great Recession was a 55% drawdown. COVID was a 30% drawdown. So there's no way to know, right, if we get a recession next year, what the drawdown will be. But you should expect some kind of drawdown in the stock funds, right? So if you know that, if you know just the GDP and what it's doing, and unemployment, the rate of acceleration of unemployment and what that's doing, you know a whole lot more than most people that are trying to manage their TSP accounts. Okay, so should you be paying attention if you're in the stock funds right now? Because right now, obviously, the market is going up, and that's fine. You want to be in the stock funds when the market's moving higher, but you also want to know that we are on the cusp potentially of a pretty big decline in stocks. So with that in mind, these are two Facebook posts that we got in the past week. Hi everyone, I'm new here. After reading the comments, I've decided to go 50-50 CNS. I've been in the G for the past 6 years. So this person has been in the G fund for the past 6 years. So they've lost a lot of appreciation, potential appreciation in their TSP account. But they're picking potentially the worst time to decide to move from the G fund into the stock funds. So that's an education issue, right? Some of the comments were pretty interesting. Most of them are, of course, ride or die, 50C, 50S. But some of them were really good comments talking about the same kinds of things we just did. So that was the one. And the other one is very similar, right? Joined halfway into my career, but it's never too late. I talked to a couple of my Wall Street buddies, and they recommended all C fund and never look back. So they put 90% in the C fund and let Jesus take the wheel. It's burying your head in the sand, and if you don't know what the potentials are coming up, then you just don't know. And so that's the point
I'm sorry, but
the group.
that's hilarious. Jesus take the wheel. That's probably the best one I've heard in a while. Because that's really what you are doing, right? I mean, you're just letting, you're letting karma, Jesus, Buddha, somebody just take the wheel. That's not a good plan.
No, and it's purely an education piece. I mean, again, you have to care enough about your retirement to want to make your account grow when the market's moving up and protect those gains when the market's moving down. And we are at a very high risk point right now. And it gets riskier over the next, particularly over September and October, because the seasonality is really against us. And if you've been reading any of the newsletters and watching any of the podcasts, we've been talking about and showing charts of what generally happens, especially during election years in September and October. So you take all of that together, and your fingers should be on the sell trigger. As long as the market's going up, you're good. But your finger should be on the sell trigger if the market starts rolling over. So anyway, that's that. TSP fund charts. So I'm going to do a little bit more detail. This is more or less the stuff that we reserve for our subscriber side, but I'm just going to go into it a little bit. This is a weekly chart of the C Fund, which we put up all the time, and I just added the relative strength indicator down here and a Fibonacci extension level up here. Okay, so those are two of the tools that we use on our paid subscriber side. So the Fibonacci extension level, this, if we go from the top in 2022 to the bottom in October 22, and we use the tool to extend out where we would expect to see the market pause or reverse. The most common reversal level is a 1.618 extension of this move. Okay, so this is, if this is 1, this length is 1.618 times that 1. And the Fibonacci, you can take a look at it. I know we have some podcasts and some blog posts about it, but as you can see up here in July, it hit that 1.618 level and stopped, just completely stopped. Hit it for 2 weeks. We had that pullback, came back up and rallied, hit it again last week. It's hitting it again this week. We still have higher lows, right? So the trend is still up. So it's possible that the market breaks through this level and keeps on going. Until it does, it's risky, right? If we get up here somewhere to new highs and above that 1.618 level, the market likely keeps going higher. But right now, the risk is really high. And we know what generally happens in September and October. And we have the GDP and we have the accelerating unemployment rate. And we are stuck at the 1.618 retracement level or extension level. So there's a lot of risk there. The relative strength indicator, when the relative strength is high above this 50 line, everything is good. Price keeps going higher. When the momentum behind that move starts to recede, you see it in relative strength before you see it in price. So we got a high in the high in relative strength right here, which was this high in price. Price keeps moving higher, but relative strength is decreasing even as price is moving higher. So the momentum behind this move is waning, and then price rolls over into 2022, right? And then relative strength comes down. And so where we are right now, we're basically at a double top where this high was this peak in relative strength. This high, relative strength is way down and falling. The momentum behind this move is waning. It hasn't rolled over yet, but it's a giant red flag. Okay. So that's it for the C Fund. S Fund, it's really pretty interesting. Instead of an extension level, now we're on a retracement level because the S Fund has not gotten back above its prior high. So from this high to the bottom in the S Fund back in 2022, it's retraced. It got past that 0.618, which is the most frequent place it would either pause or reverse. And that is the line where it paused. And it's still, oscillating along that line. But it's bumping up against the next retracement level, which is 0.786, right? And it's been doing that for the last month or so. Interesting thing about the S Fund, we have this triangle that we've talked about on the podcast before. We got a big breakout a month ago. And a lot of people, it was this whole idea that there was a rotation between tech and the underlying 11 sectors in the S&P were expanding, and we had this breakout and everything was going to be great. What actually happened was it was a head fake in both directions. We got this breakout, it sustained for a little bit and then rolled over really hard, came all the way down to test that low, and then came all the way back up. So it knocks out anybody who's long and short. And then we'll see which direction it decides to ultimately go. but anybody who got into the market here took big losses during this decline, right? And anybody who was short the market down here because it broke the downside of the triangle, anybody who was short here got clobbered when the market recovered. And that's the market's job, is to take money from everybody. From a charting perspective, it's fascinating because we have very clear triangle, break out to the upside, break down to the downside, and then it keeps going. So we'll see ultimately which way it goes. It's fascinating. And at the same time, again, relative strength is declining on this sideways move. So we shall see which way it goes. iFund, we've been talking about this for a long time, had a triple top at 82 back in 2021. Couldn't get above it, just barely last week got above it, and then this week it's trying to hold support there at 82. And again, relative strength is declining as it's trying to break through that resistance level. So there's definitely risk in all three of those stock funds. The F fund, we've been talking about this for a long time too. This chart looks obviously much different than the others because it's been in this long-term decline, and we're just starting to correct out of there, right? So if this move off the bottom is the same length, so we have this move off the bottom, we have an ABC correction. If this next move off the bottom is the same length, then the F fund gets up to roughly 103. That's the minimum projected target that we have. The F fund can come all the way back up here to the prior highs. So if the Fed really starts cutting rates, the F fund goes much higher. So the F fund is in a way better position to move up than the stock funds are right now. We have a lot of questions about the F fund, and we're going to continue to talk about it because it's really the only choice if the Fed starts really cutting rates and the stock funds start falling. Okay. All right, that is all I got. It's a little more in-depth than we usually do on the podcast, but I'm really trying to impress upon people, not that the sky is falling, but that the clouds are forming.
Right, and you got to have your umbrella out ready for it to rain. Just staying on that analogy. All right, guys, if you have any questions, as usual, you can put them in the comment section wherever you find the video. If there is no comment section, you can always shoot us an email at support@growmytsp.com, and the support team will get it over to us. We hope you guys are having a safe and wonderful Labor Day weekend, and we will see you guys next week.
All right, out here.